Ladies and gentlemen, you know what time it is. Welcome to the 88 MPH community call where we host the best DeFi projects and discuss the hottest topics within the crypto space and more. My name is Whipper and I'm a crypto enthusiast and a community volunteer at 88 MPH. Today's call is going to be jam-packed with valuable information, so make sure to stay tuned all the way to the end. Today, we have the very special pleasure of hosting Nexus Mutual, one of the top-ranking DeFi insurance applications within our space. Before we start the call, I'd like to remind everyone here on stage to please keep their mics muted unless they're speaking. If you have any questions or comments during the call, please feel free to raise your hand so that we can bring you up on stage. For the sake of getting more community engagement during these calls, we've changed the format to an open-style discussion. So feel free to jump in with your questions or comments at any time. Simply just raise your hand so we can get you can get our attention. As with tradition here at 88 MPH, we will be closing the call with a $100 raffle giveaway in the form of one MPH or MPH using our tip bot. So stay tuned all the way to the end as details will follow. On the agenda today, we will be discussing insurance within the DeFi space, recent DeFi hacks, audits, and more, followed by our news and updates section from both 88 MPH and Nexus Mutual. With that, I'd like to open the call with Dopey from Nexus Mutual. Can you please give us a brief introduction into who you are, how you got into the crypto space, and what is Nexus Mutual?
Sure. Good to meet you guys. Thanks for having me. My name is Jack. So I kind of got into crypto around 2014, 2015. So maybe a little earlier than others. It was actually probably late for me because I had friends telling me about it in probably early 2013. I actually got into it deeply in 2015 because one of my close friends he bought a bunch of Bitcoin ATMs. And kind of on Saturdays or Sundays, we'd go watch a game, have a couple of beers, but on the way we'd drive around and we'd pick up all the cash from the from the ATMs, and I'd see him pulling out tens of thousands of dollars. Obviously, only part of that was actual profit, but it's okay. There's something actually here. This isn't just kind of fake internet money. I could see it becoming more popular. So I started getting into crypto around then. I jumped in full time pretty much in the last 12 months. Actually going to be joining Nexus Mutual full time in the next couple of weeks. I've been on the Nexus Mutual Investment Committee for the past 6 months or so. My background's in traditional finance, so I'll bring a little bit of that to try and professionalize the investment space. So obviously, for an insurance mutual, pretty much the most important thing is, beyond just selling cover is investing in float, and investing the float in ideally a risk-reduced way. So Nexus Mutual, for those of you who don't know, is the largest DeFi, insurance protocol. It's technically a discretionary mutual. The difference between that and insurance is basically insurance is contractually obligated. It's also heavily regulated. Mutuals are really where insurance industry began. It's insurance basically for members by the members, and that's where we're at. So we've been around since 2018, I suppose, we just covered the cream hack, which happened recently. I'm sure most of you have seen. So that's probably the most recent thing you guys will have seen from us.
That's a great introduction. Thank you so much for that, Jack. Yeah, we're going to go deep into the protocol. We're going to talk about the recent hacks. That's actually a pretty funny story how you got into crypto. I like that. At least you got to see firsthand all the money that was being made. And at least, it's great to have you with us. And I'm glad you made the right decision. McFly, for those that are joining us in the audience from Nexus, could you just give a small introduction into what 88 MPH is so they can learn more about us as well? McFly, you're muted.
Yeah, sure. Thanks for joining, everyone. probably we will have more people joining right after. Dopey, not sure if you re-share the community call in your community, but it would be nice if it's not yet done. Like usually we are like with like 30, 50 people here, so like the more people, the better. And for people already here, 88MPH is basically a protocol allowing you to earn a fixed yield rate on your crypto assets, like stablecoins or wrapped version of Bitcoin or ETH. And we have another product where we let people speculate on the future yield you can get on Aave or Compound. So we have these two products, like fixed yield rate and a speculative tool. We name it yield token that allow you to basically bet on the variable rate you can get on Compound, Aave, Harvest, and whatever protocol we are supporting on the different chains. We are deployed on the Ethereum mainnet, Phantom, Polygon, Avalanche, and in a few moments we will have like some nice surprise for you guys on Phantom. So yeah, basically that's 88MPH.
Thanks for that, McFly. Okay, so I'd like to get started with the first segment of our call, which is focused around insurance and the use of insurance within DeFi. So it's obviously no surprise that insurance is one of the most important pieces to the DeFi puzzle. But Jack, how can we gain more awareness and how can we drive the cost of insurance down so that more users will add premiums to their yield farming strategies?
Good question. To be honest, I'm not sure if premiums really need to go down from where they're at. I think for some of the largest projects, we're looking in the realm of like 2 to 3% a year. Like if you kind of think about what that means for the insurer, you're basically saying that we think this protocol will not get hacked or exploited more than once every 30 to 50 years. Presuming the insurer wants to actually make money. So I think that's already pretty low, to be honest with you. I can't imagine that rates will go down significantly over the years. I think obviously for protocols where you're still seeing coverage rates in the 10 to 15, 20%, a lot of that is due to, in my opinion anyway, is due to unaudited code. And really, whether it's new mechanics or code that's it has not been forked from other protocols. So even when we list a new protocol, if it's a protocol that's been forked from another project, the vast majority of the code base, is essentially already known to the community. It's pretty easy for people to stake against that. If something's new, kind of revolutionary, maybe like Ohm or maybe Spell when that first came out, it's tough for people to get their heads around the code base. And then there's also just the time element. I think people feel comfortable staking against projects like Compound just because it's been around for X amount of years and has only had X amount of hacks. It's pretty, users just kind of just get a level of comfort around that. And I think it's kind of, it's probably an incorrect way to look at it. It's not necessarily true that the amount of time that a protocol's been out is, I don't really think correlates particularly well to the safety of the protocol. So over time, I think that the industry will kind of just mature. There's probably an opportunity for auditing firms to partner with insurers like Nexus to offer some sort of service there, whether it's like vaults where stakers can put their money in and kind of the auditors audit the different projects and choose where those tokens are staked against. That's something that we're looking at Nexus. And obviously all of that will, help stakers basically to get a better understanding of the risk, and that's going to adjust the rates.
Yeah, no, for sure. Nexus Mutual has seen some pretty impressive growth. As of today, I believe you guys have around like 750 million locked in the protocol. What's been the secret to your success, and how does Nexus stand out from the so many insurance competitors that we have out there?
I think a lot of it is time in the market. Nexus obviously was one of the first insurance protocols to launch. Really, it's just the nature of insurance. You need a large float really to offer cover. The nature of the beast also is that sort of, if you have $10,000 invested in crypto, between gas fees, exchange costs, etc., like, are you really going to buy cover? Probably not. I mean, if you've got $10 million invested, the gas fees and the exchange costs start to become worth it. So currently, the reality is that really insurance protocols are primarily aimed at whales, or at least larger owners. That's kind of shifting a little bit with kind of the conversations we're having with you guys and other protocols around protocols purchasing cover on behalf of the members. That way you can kind of spread those costs across a large capital pool. But that's sort of the reality, I think. And so in order to offer that level of cover, you have to have an enormous capital base. So if you start an insurance protocol tomorrow and you can only raise 20, 30 million, you can only really cover, only maybe 20% of that can be against a single project. So you can only offer, call it $6 million of cover on a single project, which might not even be enough to cover a single whale. So I think that's kind of the reality is you in the insurance industry, you get this massive moat around your float. So that's kind of allowed us to continue to grow faster than competitors, even though over the last year, 2 years, we've seen more and more protocols enter the industry.
Jack, you bring something pretty cool up, this idea of protocols sort of purchasing insurance on behalf of their users and spreading it out. Do you foresee this as taking off and maybe perhaps being the bigger aspect of insurance that's actually being purchased as opposed to the individual users? I know there's also some other interesting ways. Like I know, for example, Aave will have their staked version, which potentially could get slashed in the event of like an unforeseen hack or some sort. What's your take on that? And do you see like the explosive growth in the future coming from that avenue going forward?
Yeah, that's a good question. I think it's pretty interesting, and it's probably too early to tell, to be honest, whether 5-10 years from now, whether the majority of cover buys will come from protocols or whether it'll still be users. So I don't really have a strong opinion there. I think it might. Generally, I lean towards that it's more efficient for for DAOs and protocols just to buy the cover on behalf of their members. The average cost will be lower, per user essentially that way. It's also just a little bit easier for the insurer, particularly for new projects where the cost for the first few users buying the cover is going to be high and then obviously get lower over time. In terms of some of these tranched approaches, I've seen a couple. They're pretty interesting. I think it's not really a replacement for insurance, in my opinion. Like the purpose of insurance is not to protect you against like a 5, 10, 20% loss. That's great, and that serves a purpose. But really, the whole purpose of insurance is to protect you against catastrophe, right? It's to protect you against the risk of ruin. And these tranched approaches kind of do that. It kind of depends on the protocol, I suppose. But some of them really only cover small percentages, which is fine. I think that serves a pretty good purpose. I don't really see that it completely negates the need for cover or insurance.
Jack, I agree with you that most, maybe the insurance game is particularly played by a lot of larger players, but I'd love to educate and get others aware of what sort of coverage is available so that maybe, it might make sense for some smaller players, to protect their positions. Maybe there's just this lack of awareness or education around. I know for one, for example, you never know exactly what's covered. Is a flash bot or like a flash loan something that's covered? Is it strictly like an exploit? Could you talk a little bit about what sort of coverage is available? And what would constitute as a potential claim, and then maybe you could talk a little bit about like how the governance process works for each claim individually.
Sure. Yeah, so we basically have three different products. We have protocol cover, we have yield token cover, and then we have custodian cover. So custodian is probably the easiest to understand. It's like crypto.com, for example, you put your funds in there, and then say, for example, like they get regulated out of existence and you can't withdraw your funds for 90 days. At that point, you'd be able to, you'd be able to apply, you'd be able to put in a claim and we would pay that out essentially. So you're protecting against the inability for you to redeem the funds that you own in the custodian. And this isn't like I lost my password, they banned me because I'm a moron. It's like things that are essentially outside of your control, where the custodian is preventing, large amounts of people from redeeming their funds. We have yield token cover. Those are a little bit more complicated. So I'll kind of just skip that just for sake of ease. But protocol cover is really the majority of what we offer. And that's basically to protect against exploits in the protocol that would lead to the loss of funds for users. So the Cream exploit, for example, was a pretty good example of that. I mean, it wasn't like funds were hacked out of the protocol. It was just the way that the protocol was written and the way that they used the Oracle. It was possible for someone to exploit the system and essentially pull funds out. So the cover is written pretty broadly. In that way, it's available on our website, but it's essentially to prevent against loss of funds for users through the exploit of the protocol. And then I guess go ahead.
I was going to ask, and what about the use of like flash loans, whether it's for like an arbitrage, or how does Nexus Mutual view that in terms of lost funds? Because if I understand correctly, a lot of these exploits actually happen with the use of flash loans. Not always, but like there's like a good chunk of them. How does Nexus Mutual view these sort of things?
So I don't think the use of flash loan or flash bot necessarily. I mean, I don't think that's an issue. Like I was saying, the Cream exploit, they were using flash loans, right? And that was still a covered exploit.
Right, for sure. So how can users participate within the Nexus Mutual protocol? Like, do you guys have an area where users can come in and earn some yield, maybe put some capital to work? Maybe you could talk a little bit about that.
Sure. Yes, we have the NXM token. Basically, the way the system works is, you have your tokens, you can go in and you can stake your tokens against different protocols. And basically what you're doing when you're staking your tokens is you're underwriting the cover. So you're putting your tokens up and you're saying, I'm going to risk these tokens because I believe that this protocol is safe. And in return, you're going to get some percentage of the premiums which come in from people buying that cover. So that's basically the way that works. You can technically lever up. I know leverage is kind of a dirty word in the crypto industry, but insurance works on leverage. It's impossible to run an insurance company without leverage. Currently, you can lever 20x, which means, like, so for example, you have 100 NXM. You can stake 100 NXM across 20 different projects. You can't stake 2,000 NXM against a single project. So it's kind of forces you to diversify that way. But you can stake your whole 100 across 20 different projects. To give you a little bit of context, like for example, Lloyd's or some other real world insurer, their leverage in that way is probably closer to 100. So it's still relatively low leverage. And the reason for that is just because you want to try and diversify your risks. And I think crypto risks are still relatively concentrated. There's a chance that obviously a lot of code is duplicated across different protocols. So obviously as we begin to offer more different types of cover for different types of projects, whether it's inside or outside of crypto, that's probably something will increase. And that allows users basically to earn a relatively good yield on their tokens. Sorry. And then the other way that you can earn funds would be to act as a risk assessor, which is basically when a claim comes in, users are able to vote on whether it's a legitimate claim or not. When you vote, you will be paid, a small amount of tokens for voting on that.
That's pretty cool. Could you talk a little bit about like how claims are decided and like how does governance play into that?
Yeah, so it's a discretionary mutual, so it's a pretty standard setup. I mean, this has existed for hundreds of years. Claims come in. There's like I think there's a 3-day cooldown period, which basically means between the time that the exploit occurs, we basically ask that you wait 72 hours before you submit your claim. More than anything, that's just to give risk assessors time to kind of, to understand what's happened firstly, and kind of discuss it internally before the community then makes their votes. So, you'll put in your claim and you'll say, I bought $10,000 worth of cover. I've lost, $9,000. I need to be made whole. So then the community will vote on that, presuming it's a legitimate claim. The community will obviously, vote to approve those claims. And, once that's been approved, typically within about 48 hours, the user would receive their funds from our capital pool. Then the question I get pretty often is, well, why don't people just vote against the claims? So the logic here is kind of a little bit of game theory to it, and then there's also some mechanics which actually kind of prevent it. So one is essentially, well, if a claim comes in and it's going to cost the mutual $100,000, why wouldn't I just deny it? Because then I don't want the mutual to lose money. Well, the answer would be, if we go around and start denying honest, legitimate claims, then people's trust in the mutual falls. People stop buying cover and the value of the mutual goes down. So there's kind of that element of, if you're playing an infinite amount of games, you want to do the right thing such that over the long term, the mutual benefits. The other component is risk assessors can get their stake burned if you don't vote with the consensus. So what that means is, let's say, for example, there's a claim that comes in and some nefarious individual decides that, no, I'm going to vote no against this claim, even though it's clearly legitimate. The idea is that across the many thousands of members, most people will realize that, like I just said, if you're playing an infinite amount of games, then what you want to do is you want to vote legitimately. So presuming that claim goes through, if people did not vote with the consensus, that means they voted no when the majority voted yes. People that vote no will get their stake burned, which means all the tokens that they put towards that are lost. So that's kind of an incentive for people to kind of vote based on the truth.
I really like that, Jack. Is that something that's unique to Nexus Mutual, or do you see that with some other insurance protocols as well?
I think some other protocols do that. Some of the other mutuals, I think Bridge Mutual and potentially InsureDAO I think they have kind of similar setups for their risk assessment, because they're basically doing the same thing we're doing, which is discretionary cover. There's a couple protocols that are in parametric, which is basically using an oracle to decide if it's a yes or a no.
Cool. For those in the audience or on stage, before we head to the next segment of our call, which is going to be focused around audits and recent hacks, if you have any questions, please feel free to jump in. Just raise your hand so we can bring you up on stage. So, Jack, for the next segment of the call, I just want to focus a little bit about, some of the hacks that we've seen. And I'm just wondering, would you say that the current audit system that we have in place is sufficient to prevent these hacks? Or what do you think that we can do to just get better? Or is this just how it plays out? With each hack that happens, we just get stronger as a community, as an industry in total. What's your thoughts on that?
I'm not sure I'm the best person to have an opinion on this. I'm not the most technical person in the world, to be honest with you. I don't code at all. But I will just say, I think generally that anytime there's an industry which is kind of breaking new grounds, you're trying to develop kind of, throw stuff at the wall and see what sticks, there's always going to be risk. I'm not sure how much of that risk can be completely removed. Obviously, I think having your code audited is probably the bare minimum you can do. And I think if you're not doing that, I've heard arguments that the auditors are basically. I've heard people make the argument that the quality of the auditing firms is low, and therefore, why would we spend, pretty exorbitant amount of money that some of them charge and wait 6 months because there tends to be really big backlogs? Why would we do that if we think the quality of the auditing firm is low? I've heard that argument, so potentially. One thing that needs to happen is auditing firms need to step up their game a little bit. There probably needs to be more of them. I don't really know anything about the auditing firms, so I'm guessing the reason they haven't done that is it's probably pretty complicated. I'm guessing it's hard to hire people who have the necessary skills, because they're probably everyone probably wants to hire them to work on making new protocols.
Right. Do you know of any auditing firms that have some sort of a insurance guarantee that they've partnered up with one of the insurance protocols for a specific amount of time once the audit's been done? Or if not, do you ever see that is even becoming an actual product that might ever come to market?
Yeah, I saw that the other day. I can't remember who it is off the top of my head, but I remember distinctly that I read that. I don't know if it was a large firm or if it was kind of a new upstart, but I have seen that. It's pretty interesting. I mean, that happens in other industries, right? When, particularly with audits, you basically give some sort of guarantee on your work. I think it's interesting. I think they could probably do it. The cost would not be zero, though. And it tends to be just the cost doesn't just disappear. It has to get absorbed somewhere into the industry. So basically, they're just going to charge higher cost to the protocols that are paying for the audit anyway. And I think that you could also make the argument that potentially that it has some sort of negative impact. The auditors feel like they can work a little less hard. It's kind of a perverse incentive if your whole job is to make sure that this code is perfect, but then you have this insurance that, if we messed up, that's sort of we're going to be covered anyway. And that's the classic attack on insurance generally, right? But I think for the audit industry in particular, it kind of makes sense, right?
Yeah, those are good points. One of the scariest things that I've seen recently was this notion that Aave had the same potential exploit bug as Cream Finance, but they managed to patch it up. Jack, what exactly happened with Cream Finance? I know you said that you're not super technical, but could you explain what the actual exploit was? Could you also explain I know I heard something that $10 billion was taken out of Aave because they were anticipating or they were scared of this patch fix or whatever. Could you? I'm sure that so many people here listening would love to learn what exactly happened. I know a lot of people provide liquidities to these projects. It'd be great to get a better understanding of what actually went down.
I'll give you an answer just because I'm kind of on the spot here. But again, I'm definitely not the person to give the answer. What I read was basically the person took a loan, like a flash loan, and then they basically converted it between a couple different tokens, and that kind of, my understanding was it like created some sort of weird infinite loop in one of the price oracles, and then that basically allowed them to pull a huge amount of funds out of Cream. I don't know how it happened. There's tons of people way smarter than me have written up threads on Twitter. I'm sure you can find them. But that was kind of my understanding, was basically it was a price oracle issue. And that's what tends to be an issue in like almost all of these exploits.
Yeah.
Is like by doing X, Y, Z, you can trick the price oracle into thinking that you have X amount, and then you can pull all these funds out. And that's kind of why oracles actually matter, and why you don't just pick a random kind of garbage tier oracle.
Yeah, for sure. Absolutely. So I want to jump into our next segment, which is focused around news and updates. Jack, what could you say is like super new and exciting or worthwhile mentioning to those listening today surrounding Nexus Mutual? Maybe it's some things that you guys have planned coming up. Anything that comes to mind that you want to share?
Yeah, we have a proposal that's probably going to go live later today. The proposal is to pull about 8,000 ETH out of our capital pool and send it to the community fund. It's going to be used for a variety of reasons, but primarily is going to be used to purchase WNXM, which is our wrap token, off the open market. We tend to believe that it's trading below book value, essentially. So because of that, we think it's accretive to the mutual to do so. So that's pretty exciting. And then really our dev team is working super hard on version 2 of Nexus Mutual. And that's going to introduce some really cool mechanics around delegated staking and kind of being able to piece out all of the different components of insurance, discretionary cover. Because you basically have team who sells the cover, you have underwriting the cover, you have, trying to assess the risk. You have all these different components. And rather than having them in one protocol and basically forcing everyone to do them, the idea is that you can kind of piecemeal it out and then hopefully use Nexus as a kind of a framework that people can build on top of. And that's pretty common in the insurance industry. You have like Muric Re, Zurich Re, all these large insurance companies, and all they act as at this point is just reinsurance, which means they offer insurance to other insurance companies. So basically, the key skill that they bring is they have an enormous amount of capital, and then kind of everyone else who does things better than them can kind of specialize in their own section. So how that might work with Nexus, for example, would be we have this enormous capital pool. If someone wanted to use that capital pool to underwrite insurance for, let's say, earthquakes in, South Africa, you could do that. You would basically be able to build on top of the sales layer, create a new product. In that way, like people that specialize in, say, for example, insurance sales, they could just do that, and they don't have to really worry about what happens. They don't have to worry about the blockchain. Kind of, they're just able to use this decentralized capital pool to basically be able to underwrite cover for the types of products which are pretty hard to get capital for. So, like for example, like just to give you a quick example, like earthquakes and fire, insurers typically find it hard to find capital that will underwrite that. So what normally happens is some small percentage is covered by insurance companies, and then the government acts as a backstop, and they basically put their capital up to underwrite the insurance against the earthquake or tsunami or whatever it is. But that's obviously expensive. It's not ideal. So the hope is that kind of by piecing some of these things out, we can pick off what are small for the insurance industry, but still billion-dollar markets.
Super, super cool. It looks like we have a question from Top Gun. Go ahead.
Yeah, hi. Quick question. I mean, if there's a hack, for example, and it's justifiable and there's settlement, and then, I mean, sometime in the future, some funds are managed to be retrieved. What happens in this situation?
That's a good question. Yeah, it's actually happening pretty common. That, or perhaps at some point in the future, the protocol decides that they're actually going to pay back the users. So it kind of depends. I think the ideal situation, and especially going forward, what we really want to happen is, and this is what happens in traditional insurance, would be we take on that. I think it would end up probably being an NFT. Like we would probably take on that or some sort of token, and then that would give us the right to retrieve those funds. Yeah, so that's pretty common in in traditional insurance as well. Like say for example, you have D&O insurance or whatever, and eventually you're able to recuperate some funds from the other party at the end of the lawsuit. Those funds don't just go back to the person who bought the insurance. They don't end up making money from the claim. The person who bought the insurance is made whole, and then the insurer has to sit on that risk for call it 2 years, and then eventually they get some of those funds back from the other party.
Thanks.
Yeah, no worries. Thank you.
Thanks for that, Top Gun. I just want to pass it to McFly here. So McFly, maybe you want to talk about some of the news and updates that are surrounded 88 MPH?
Yep, sure. I got a question for Dopey just before starting on the other topics regarding putting some capital at work. Like currently, there is kind of idle capital in Nexus Mutual. I was wondering what's the next plans for you internally to put all of that at work, or at least a certain percentage to, just make it more active management inside the Nexus Mutual protocol.
I don't know if you were cutting out a little bit. I think the question was around Lido, the ETH2 staking protocol, and our investment there.
Yeah, also, so yeah, you are already doing that with Idle, and I was wondering, like, is there any plans to increase the amount of capital you are putting at work, like having this active management? Is there any other plans?
Yeah, so on the investment committee, that's our sole focus, is trying to utilize the flow as efficiently as possible. I think right now I want to say it's about 32,000 ETH is in Lido, which is a pretty sizable amount. It's about maybe 20% of the capital pool, something like that. Obviously, we want to invest all the capital. I mean, the goal of every insurer really should be to invest close to 100% of the float. Obviously, as an insurer, it's a little tougher for us versus some other DAOs or treasuries, because at any given point there could be a massive claim. So we have to kind of have access to that capital. So we can't just lock it up in, for example, discretionary hedge fund and just only be able to get access to the funds once every 3-4 months. That's really not going to work for us. So we want to deploy more of it. Our experience right now is that there's not that many quality options for treasuries to deploy substantial amounts of capital on chain, where there's quality price oracles, without us taking on more risk than we're comfortable with. There are other things we're looking at. Rocket Pool just launched. That's another ETH2 staker that we'll be looking at pretty seriously. ETH2 staking to us is pretty similar to like a bond. You're still able to basically stay long ETH, but you kind of get this relatively fixed kind of yield on it, with what we consider to be a pretty minimal amount of risk. And then probably somewhere in the region of 20 to 30% of our pool will end up being invested in more risky asset classes. Particularly, I'm interested in like lending protocols. I found that interesting. I read an interesting paper the other day around traditional insurers are basically filling in the gap in the mortgage industry in the real world. Basically, a lot of mortgage and other funds are being regulated heavily around the amount of capital that they can deploy in certain industries. And some insurers are kind of stepping up to basically offer long-term loans on infrastructure projects, for example. And I think that's probably something that will extend, especially in like zero rate environments. It's pretty important for insurers to try and get a little bit of yield. So I think I kind of try and take that thinking, like what are real world insurers doing, and trying to bring that into the crypto space and kind of replicate it as close as possible. Obviously, there's things that we can do better than them, but at the same time, like it's probably not a great idea for us to put like 5,000 ETH in a Ponzi. Maybe I would do that with my personal account, and probably not have an issue with that. But it's pretty tough, honestly, for a insurance mutual to responsibly invest, close to $1 billion of capital.
Definitely, you need to stay liquid also and manage the risk. So yeah, that's a big challenge for sure. So yeah, cool. Weber, you want to close this section of the call?
Yeah. So if I'm thinking that we should stick with our news and updates.
Okay.
Unless there's anything else Jack wants to add with regards to news and updates from Nexus.
No, nothing on my end. I'm happy to sit around. I'm interested to see what you guys are up to.
Cool. So yeah, like the main big stuff we are working on since some weeks is the bridge, plus deploying MPH Minter and the converter directly on Phantom, Avalanche, Polygon. All of that is currently happening. As I said last week, we are doing it first on Phantom. So I'm like currently basically trying the bridge with AnySwap for bridging MPH from Ethermanet to Phantom. So it's working, so that's a good news. And like the last thing we need to do is double check some stuff with the minter and the converter. It's taking more time than expected. As always, it's a human process. So yeah, just be patient. It's happening, but yeah, there is a lot of little pieces to put together, and some team members were sick last week, so it wasn't our most productive week. But yeah, we basically I'm testing that right now, so that means that it should be ready really soon. But I don't want to give you an exact date because you may be disappointed if it's not released exactly on that day. But yeah, just I want to let you know that it's happening. And when that thing will happen, after we can start building some TVL on Phantom and start thinking also how we want to distribute rewards we can get on that network. So yeah, there will be a lot of different discussion proposal in the governance. So we will make everything more active there also. So be sure to have like some MPH or XMPH to vote on the next stuff that will happen. And talking about MPH, XMPH, maybe you heard about some project or ideas to increase the liquidity of 88 MPH on different networks. working with Home or working with Olympus DAO or doing our own stuff. The thing with that is basically like the straight answer is we won't do anything close to what Olympus is doing, but we can borrow some concept from them to build liquidity on other network. Probably what we will do is we will experiment next month when we are done with the multi-chain deployment. So when every chain will have its own NPH minter, its own NPH converter, its own bridge, we will work on improving the tokenomic and improving the liquidity. So for the liquidity, what we can imagine is allowing people to lock infinitely their LP token, and in exchange they get some discounted NPH directly minted from the minter. So basically it's like doing something close to liquidity mining without doing the traditional way of liquidity mining. It's another concept of liquidity mining, if I can say like that. Basically, it's just like we mint some NPH and we stop distributing the governance treasury NPH to the miners, the liquidity miners. So basically, at the end, it's the same thing. We can do that at a small scale, and we can put all of that under the governance voting process, of course. So that's the first thing, like trying to get our own liquidity protocol, own liquidity. That's the trend right now, and it makes a lot of sense for us since we started that. We spent a lot of money incentivizing liquidity providers. Like renting liquidity is not the best idea, and we know that since the beginning. But yeah, we need to iterate on that. So that will be probably the path we will follow. And the second thing is regarding tokenomics is we were exploring when Andre Cronje published, I think it was last May. It was some contract, a fork of Curve Gauge. So it's pretty battle-tested contracts that will allow us to implement a gauge model on top of the MPH design. So you can imagine like the CRV model where you have like you stake some CRV, you lock your CRV, you vote on some pools, and these pools get more rewards than the others we're getting less votes. So we can imagine the same design for 88 MPH. Each pool on 88 MPH receives a certain amount, equal amount of MPH rewards currently. But we can imagine like some game theory on all of that, and just allow people to deposit, lock some MPH in different pool of their choice. And these pools with the most MPH locked will get the most MPH supply minted when someone deposits. I think, and that's ramping also, that is really the way to do things to really increase the quality of the tokenomic of MPH. Currently, what you see is when MPH pump, there is always someone who wants to basically dump on everyone else, and it's like logical stuff. It's open market, and there is not a lot of reason to hold MPH currently, except like just being bullish on MPH, of course, and the staking rewards, like we distribute 100% of the protocol revenue to our MPH takers. That's another good reason. But let's imagine we want to add a third reason to hold MPH. Currently, the gauge model is the best, at least in our opinion. So we will try to experiment with that and see what you think, guys. So yeah, pretty excited by that. So we will start working, exploring this idea in probably end of this month, early December. Like just finishing the main, like the multi-chain deployment, and after we'll see what we can do with these two stuff. So locking some LP tokens to get discounted MPH. So basically, it's bonding, but it's better to don't qualify it as bonding, because if you are a doctor team, offering some bonds is probably not a good idea, especially when your legal entity is in Switzerland. So we prefer to don't call that bonding, but yeah, let's imagine that it's something close to that. And the gauge model, and I think that kind of stuff will be a game changer for the tokenomics of NPH. So yeah, we will see. And the last news, we got some talks with ZK Sync. As you mentioned it before, I think I already told you that. But right now we are officially onboarded there, and they still need to prepare some stuff on their side. But they told us probably early December we can start building on top of ZK VM. So pretty excited by that. And yeah, that's it.
Thanks for that, McFly. Before we wrap things up, did anyone from the audience have any questions or comments that they wanted to put forward? I guess everyone's a little bit tired today here on a Friday. Very quiet audience today.
Yeah, I'm pretty surprised. Usually we are doing it on Thursday, so yeah, Friday, we have 5 times less people, right?
Yeah, it's super weird.
Yeah, it's all your fault, Whipper.
Yeah, it's all my fault, guys. I had some last-minute travel plans that I had to do yesterday, so but it's been great anyways. We had the opportunity to have Jack with us. We learned so much about Nexus Mutual, and the next time you guys are playing with these DeFi protocols, you should consider Nexus. Do your own due diligence, of course, do your own research, but we've really learned a lot, and we appreciate you coming with us, Jack, and educating us. So it looks like no one has any questions or comments, so we're going to head to the last segment of our call, which is our raffle. And Jack, feel free to participate if you'd like. So I invite everyone in the audience to head over to our general chat, where I'm going to ask you to put in a number between 1 and 15. And the closest to it, or whoever hits it, will win our raffle, which is $100 worth of NPH that will be tipped to you using our Discord CC bot. So please go ahead and put in your number now. Thanks, McFly, for dropping me the number personally.
Let's go, lucky number 11.
All right, guys, we've got some more of you in the audience here. We're going to give you another 30 seconds.
It's $100, guys.
Okay, looks like we're going to close this one out. And interesting enough, we actually have a tie. So the tie is between Jack and Synsex. I think that's how you pronounce his name. I think we should split it up, boys. What do you say?
You know what? I'll do you a solid. We can give it to Synsex. It's my gift.
All right, cool. Thank you for that.
Your lucky day.
Number was 12. All right, everyone. Thank you so much for coming out. We hope you enjoyed the community call as much as we did. We look forward to having you guys with us. Jack, before you leave, maybe in our general chat, you can just drop some information where we can continue to follow the amazing success that Nexus has had. Maybe you can drop your Twitter handle, or maybe your Telegram group or your Discord channel. This way people can stay up to date. That'd be amazing. And we really look forward to hopefully having you on our call sometime in the near future. And with that, I want to close out and wish everyone an absolutely wonderful day, and hope everyone has a great weekend. We will connect with you guys on the next one.
Cheers. Thanks, guys.
Have a good one. Thanks for coming on.